This podcast is brought to you by Custom Plan Financial Advisors, Inc., an independent insurance managing general agency in Canada. FinancialPodcast.ca was developed with one goal in mind: to educate Canadians on important topics that affect their financial well-being and make it readily available to all. We welcome you to plug in and learn with us. If you have questions, please email us at contact@financialpodcast.ca.
Hello and welcome to the podcast. Today we'll be talking to Stephen, who is an independent advisor with Small Business Financial Advisors and is also contracted with Investia Financial Services. We will be talking today about registered disability saving plans. Thank you and welcome to the show.
Thank you.
Now, Stephen, I guess we should start by the very obvious. What's an RDSP?
So an RDSP is a long-term savings plan for Canadians who are under the age of 60 and that qualify for the disability tax credit.
Okay, and what is the disability tax credit and how do you qualify for it?
So the disability tax credit is, there's many different qualifying criteria for it, whether it be vision, speaking, hearing, walking, elimination, that's always a fun one to discuss, mental functions for everyday living, and dressing, feeding yourself, and the last one being life-sustaining therapy.
Okay, and how would you get qualified with this? Is it a form through the government or?
So the form is, if anybody were to Google T2201, they would get to CRA's website, and that's where they can pull up the form. The first page would be the page that they would fill out their information on, and then the doctor would fill out the rest, certifying what their issues might be that would qualify them for the disability tax credit, and then that gets sent off to CRA, and then CRA approves it.
Okay, and how does it work? How much can you contribute, and is there any contribution from the government standpoint?
So there's quite a bit from the government, actually. There's up to $90,000 to collect. So it's quite substantial, and it depends on income of what should be contributed or even if there needs to be a contribution. Some people could collect up to $20,000 without putting a dime into the account because if their income is less than the lower threshold amount, and it changes every year, so I hesitate to just throw out a number just because the number does change all the time, or annually, I should say. And they can get up to $1,000 per year just for having the account open. So if somebody on social assistance, they're low income, obviously, they would be able to get $1,000 a year just for having the account open. If they were able to put money into the account, then the government matches it for the first $500 per year 3 times. So you put in $500 or something less than that. That's matched 3 times up to $1,500 per year. And then the next $1,000 is matched 2 to 1. So it's quite substantial. Now, if your income is over the threshold amount, then you're matched 1 to 1, which is still a pretty substantial matching program. So you put in $1,000 and the government puts in $1,000. So you can be making $1 billion a year and you will get matched 1 to 1.
And who gets this tax credit? I mean, when someone's disabled, I'm guessing that the other person would have a dependent. Is that what it is? And
that's quite possible. Like anybody could have the disability tax credit. You or I may just not know that.
Okay.
You know, somebody that is type 1 diabetic, for example, they could qualify for the disability tax credit based on the criteria that's in there. So, you know, for them, they could have a regular full-time job, make $300,000 a year, still claim that tax credit on their taxes and save on their taxes. They can get a bigger tax refund, for example.
Okay, and I'm guessing for dependents like younger children and things like that, it would be the parent and legal guardian, or how?
Yeah, the parent, and that could even go through to adults. So if I'm an adult that is, say, on social assistance, I can qualify for, or if I qualified for the disability tax credit and you're my guardian, then you would be able to claim my disability tax credits on your taxes because I don't have any taxable income because social assistance isn't taxed. So then you'd be able to claim those on your tax return because you're supporting me, whether it be financially or, running me around all over the place and stuff like that. So, yeah.
In the cases where the parents of a young child that may be disabled are divorced, who ends up getting the tax credit in this case?
So the tax credit, that's ultimately up to what they agree upon, I suppose. So generally, I would suggest the higher income earner would get the tax credit. And I've dealt with a lot of families that have, unfortunately, separated and divorced. And so it comes down to, we talk about it and go, okay, mom makes X number of dollars, dad makes, half of that. So let's give it to mom. And then how about you split it at the end, right? Because there is a dollar value there. So let the higher taxpayer claim it. And then if it makes sense, split it or do whatever you want in your divorce judgment.
Okay.
You are listening to financialpodcast.ca.
In the cases where the child might be temporarily disabled, and there's a chance that while he may qualify for the disability tax credit today, may not in the future, does it still make sense to open our RDSP?
Definitely. And the reason being is because you get to basically invest the government's money interest-free. So even if the disability tax credit only lasts 5 years, you get to use that government money for this, 5 years that's upcoming to earn income on the account when you invest it. And so what happens is even when the disability tax credit is no longer qualified for and the RDSP has to close, then the government takes back their money, but it's just their money that they put in. So if they put in $3,000, they take back $3,000. Okay, so if you've earned $400 on that $3,000, you get to keep the extra $400. So it's like an interest-free loan.
And on top of that, so what if I'm understanding this right? If with the government's grants or the money that's been put into this, you'll accumulate interest based on what you've put in and what the government put in.
Right.
So at the end of this, if they pull out their money, you're still allowed to keep the interest you made on the government share of the money.
Right.
Oh, that's pretty interesting. So how do I go about opening up an RDSP?
Give me a call and we can get her done. I know, that's the simple answer.
Right.
You can go to any financial advisor, any financial institution like a bank. A lot of the banks are, let's say, pausing at the option to open the account for you. I know some banks just have told people we don't do that anymore. So find somebody that actually knows what an RDSP is and can actually help you get the grants and bonds, because there are a lot of hoops to jump through.
Okay.
And it is a lot of administration. So not everybody wants to do it. So make sure you find the right person to do it for you.
And do you have access to the same investment options that you'd have in an RSP and all that stuff? Or
almost. There's very limited companies that do the RDSP. So you have, the major banks, whether it be BMO, RBC, et cetera, and then you've got, as financial advisors, we can open it up through BMO because they've allowed it to have independent advisors do that, and Mackenzie Investments. And there's always, there's rumor that shortly there'll be another mutual fund company coming on to be able to do that. So, maybe in 20 years, everybody will be on the bandwagon and supplying everybody with RDSPs. But at this point in time, it's very limited.
Limited compared to RSP options,
TFSAs and things like that.
Yeah. Okay. And I'm guessing within these investment options, there are some quite very safe investment options.
Yeah, you've got the whole, level of risk tolerance that you can go through, whether you're low risk or high risk or in the middle. You can pick whatever you want and go from there.
So what happens to the RDSP if the owner passes away?
So the owner is different than, say, the beneficiary. Because the beneficiary would be the one that qualifies for the disability tax credit.
Okay.
So if the owner passes away, then I would hope that in their will, they have a guardian or a trustee that would be able to step in and take over the account.
Okay.
In the event that the beneficiary passes away, then the account has to be closed by the end of the following year of their death. So if they passed away in July of 2017, then it has to be closed by December 31st of 2018.
Okay.
So you have time to recoup any losses if the market was down or whatever the case might be, and just deal with it, because it can take some executors a long time to deal with estate issues.
Now, I know we talked about divorce and who would get the tax credit, but if we go back to the owners of an RDSP, if the parents are still together, can they be co-owners of this RDSP?
Oh, definitely. You can have as many owners on the RDSP as you want. So it could be mom and dad and, the alternate guardian or trustee that's going to be coming on later if mom and dad passed away, even if they're divorced, or you could have mom and older sister or whatever. You can have a whole combination of different people on the account for sure.
Can the ownership be transferred to the child after age 8, like once they're 18 years old?
Yeah, once they become an adult, and if they're capable, then it can definitely be transferred to be in their name.
Right.
In some cases, parents or legal guardians, if they have trusteeship, then they will still put it into that beneficiary's name as well, but they will be the one that is signing for them. So there is provisions for that as well.
Okay. And how can you use an RDSP? Are there certain ways that you need to withdraw the money, etc.?
Like I said at the beginning, this is a long-term savings plan. So it takes at least 30 years to collect all the money and to have it guaranteed to be yours. Okay. And I say guaranteed to be yours because the government has a 10-year holdback rule. So you put in money today, the government puts in money today. In 10 years, you could access it, but any money that's gone in the last 10 years would go back to the government. Okay. So you want to be careful with that this is not let's just save for a car in 5 years, or let's, save for a house in 20 years. This is at least a 30-year plan to be able to collect all the grants and bonds and to be able to use it without penalty. So think of it that way, that if somebody is 19, so now they're an adult and they're collecting all the grants and bonds possible, that it could effectively take until they're 39 to collect all the grants and bonds, but they can't access it until they're 49. Okay?
Yeah.
So then at 49, there are no limitations. They can close out the account, pay the tax on the grants, the bonds, and the growth, and do whatever they want with it. If they want to take a trip to Mars, have at her. If, whatever the case might be. So they're able to do whatever, whether it's buy a house, supplement their income, whatever.
And just, I know that RESPs are something that most Canadians know quite well. RDSP, maybe not as well known. I'm guessing it's the same sort of thing, tax deferred growth inside the RDSP. And once you take the money out, then you pay the taxation on the growth.
Yeah.
Right.
Yeah. So when you've got, the bonds just go in for having low income. So that's the bonds. And so when they come out, those are all taxed. Now, you have your personal exemption amounts plus your disability tax credit. So really, at the end of the day, you're not going to pay a whole bunch of tax on that. The grants, in order for a family to get the grants, they need to have a corresponding deposit. Okay, so if they put in $100 and they qualified for the 3-to-1 grants, then the government will throw in $300. So once they've collected all those grants, then they can pull that out. And there's a formula, of course, because everything's got a formula when it comes to these sorts of things. Some of it is contributions, which are tax-free because you're putting in after-tax money. The grants, the bonds, and the growth all grow tax-deferred, and a percentage of those comes out annually for the individual.
You are listening to
Financial Podcast.
.ca.
Can you elaborate a little bit, because we've been talking about grants and bonds quite a bit during this interview. Can you give us a little bit more information on what is the difference between a grant and a bond?
Sure. So the bond is strictly, you have low income, you can qualify for the bond. Okay. So for example, if you're on social assistance, you can get the bond without putting any money in. You just get the money. Okay. So up to $1,000 a year, up to $20,000 total. That's the bond part. Okay. The grant part is you have to have a deposit in order to collect those grants. So there's 3-to-1 grants, there's 2-to-1 grants, and there's 1-to-1 grants.
Okay.
So if your income is moderate, we'll call it, there is a threshold number which changes every year. But if you're in the lower 2 tax brackets, that's where you collect the 3 and 2-to-1 grants. Okay. So if you put in, these are the maxes for each year. If you put in $500, the government's going to put in $1,500 of 3-to-1 grants. And then you put in another $1,000, the government's going to put in $2,000 of 2-to-1 grants.
Okay.
And so that would be the grants for you. If you're in the higher tax brackets, then you just qualify for the 1-to-1. So you put in $1,000 per year, the government puts in $1,000 per year.
Okay, that makes sense. So the lower income, the more the government is willing to help you out.
Right.
Okay. So how much does it cost to open up one of these RDSPs? Or is there a cost associated to these whatsoever?
No, not at all. So the opening up an RDSP is just a matter of time, filling out paperwork and making sure that all the signatures are in the right places and stuff. And as the financial advisor that's doing it, or the banks, they all get paid based on what's in the account. And it's all based on the management expense ratio fees that are taken right off the top, and that most people don't see because it's done in behind the scenes. So there's no fee out of pocket in order to open up an RDSP.
Okay. It sounds to me, and you can confirm this if you can, what's the percentage of Canadians that it could actually qualify for this that are actually doing this?
Well, that number depends on who you talk to. That number changes quite a bit. But I would estimate that there's probably at least 10% of Canadians that would qualify for the RDSP. So if we've got 35 million Canadians, 3.5 million would qualify. Even if you took half of those and said it was 1.75 million, that's a lot of people. Yeah. And when there's only 200,000 opened in the country, there's a lot of work to be done to help these people.
So you're saying there's about 200,000 of these accounts open so far, and there's definitely, so we really need to get the word out there.
Oh, 100%. Yes. There's still a lot of people that have never even heard of the RDSP and that have qualified for it for the last 10 years.
For new immigrants to Canada, do they still qualify if they're a permanent resident, or is it just for Canadian citizens?
No, as long as you live in Canada and you qualify for the disability tax credit, have a valid social insurance number, you can open up an RDSP. So you don't have to be a permanent resident. You don't have to be a citizen. You have to have a SIN number, a valid SIN number. Even if it's one that expires, as long as you've got a SIN number that's valid, you can open up an RDSP for yourself, your child, whatever the case might be. But that's what triggers everything, is the social insurance number.
Okay. There's a lot of great information that you just shared with us. And what I'd like you, if you could, is tell us a little bit more about you, what it is that you do, your qualifications, and how do we go about getting a hold of you if anyone has additional questions.
Okay. So how I got into all of this was about 7 years ago. Good friends of mine came to me and said, "We have a son with autism. We heard about this RDSP. What is it?" And I was like, "I don't know. I'll get back to you." So after 3 months of research and looking into, who does what and how poorly they do that with the RDSP, I found that it was something, one, that my friends absolutely had to do for their son with autism, and two, with the lack of assistance that people had out there and information that was out there, because it was so fragmented, that I just kind of made it my mission to be the guy that helps out people with the RDSP. So that was kind of how it got started. And then I just started figuring out who qualified for the disability tax credit, because as an accountant, I didn't know, I always appreciated when somebody had the disability tax credit, because it's like, woohoo, you're going to get a tax refund. This is awesome. But when it came to knowing who could qualify for the disability tax credit, I hadn't really researched that until that point in time. So, I looked into that and then found that, oh, look at that, type 1 diabetics qualify. And so mom and daughter in the same family have type 1 diabetes. And so this one family of 4 has 3 disability tax credits that dad is claiming because he's the one going to work and mom's at home, taking care of their autistic son and, just running the family finances and stuff like that. So that's where it kind of started from. And then from there, it just word of mouth and people started to call me and I just had to be on everything.
You became the resident expert.
Exactly.
So how many of these would you have opened up for clients so far?
So currently it's over 300.
Wow.
That I've done. I have seen some very interesting situations where the government has messed up on different things, and it happens. We love to pick on the government, but we all have our issues, of course, from time to time. But there have been some very interesting situations that I've come across, and having dealt personally with all of these different clients, been able to find how to deal with it and get the clients what they need, the grants and the bonds that they qualify for, what they should have in their accounts. And also with transferring accounts from different financial institutions, found that there's a lot of institutions that just sort of say, oh, we don't know why you're not getting grants and bonds. Good luck. Once you figure it out, let us know, because maybe we won't tell the next person. So, it's just one of those things that it's just a very poorly administered or distributed type of thing. And so I've got clients across the country that I help out. And
it sounds like whether the client wants to deal with you or anyone else in the future, the most important thing to remember here is make sure you have you select an advisor that has experience with our DSPs. I mean,
yeah. And even like I've talked to people who already have an advisor and they have opened it up, but it hasn't been working the way it should be, i.e. they haven't gotten the government money that they should have received. And so what I tell them is just, have your advisor call me. We'll go through it. I'll help you out. We'll get it done so that your client can get what they're supposed to be getting for their future.
Oh, that's excellent.
You are listening to financialpodcast.ca.
Well, I can't thank you enough. If anyone does want to reach out to you, how would they go about doing that?
So I suppose the email is probably the easiest, because then they can email me any time of the day.
Sure.
So my email is Steven, Steven, at rdsplan.ca.
Excellent. Well, thank you again. I can't thank you enough. I think this is really, really good information, and we need to get the word out there.
Definitely.
Thank
you.
you. Thank you.
The views expressed here are those of the participants and not those of Custom Plan Financial Advisors, Inc., its affiliates, or subsidiaries. This is not intended to serve as a complete analysis of every material fact regarding any company, industry, or security. This presentation may contain forward-looking statements. Investors are cautioned not to place undue reliance on such statements, as actual results could vary. This site and podcasts are for general information purposes only and does not constitute investment advice and is not intended as an endorsement of any specific investment product or service. Individual investors should consult with an investment professional about their personal situation. Past performance is not indicative of future results. If you are unsure about what is the best course of action for you in your financial planning, then we suggest you consult a fee-based independent financial advisor or get in touch with us to discuss your individual situation. Our phone number is 604-687-7773.